9:47 MEST, March 14th. COMEX Silver Futures Desk, New York. Shanghai Gold Exchange Physical Trading Floor. COMEX screen shows silver futures at $28.50 per ounce. Calm, stable, unremarkable. Pull up Shanghai dealer quotes right now. Physical silver trading at $85 per ounce. That's not a typo. $85. A $56.50 gap. 300% premium over COMEX paper. Refresh the Shanghai dealer sites. 1,000 ounce bars showing sold out across every major venue. COMEX bid-ask spread widening to $3.20, 10 times normal. Physical premiums in China exploding from typical $2 to $3 over spot to $56.50 in a single session. While Western paper markets show business as usual pricing, Eastern physical markets are experiencing a full-blown supply crisis. One Shanghai dealer posted no inventory, no timeline, price negotiable only. The divergence isn't a mispricing, it's proof two separate markets now exist. Paper says $28, physical says $85. The math doesn't work. And here's where it gets insane. The worst may be yet to come. By 10:02 a.m. Eastern, the scale of the divergence became undeniable. COMEX futures held steady in the 28 to 29 range, trading volume normal, bid-ask spreads only moderately elevated. Toggle to Shanghai Gold Exchange physical market data. Spot silver premium hitting $58 over COMEX, that's a 203% premium. In a functioning global market, arbitrageurs should be swarming this opportunity. Buy COMEX paper at $28, sell Shanghai physical at $85, pocket $57 per ounce. The trade is so obvious it should execute itself, except it's not happening. Why? Because COMEX can't deliver the physical metal required to complete the arbitrage. Shanghai buyers demand actual bars, serial numbered, allocated, in vaults they can audit. COMEX offers cash-settled contracts backed by inventory that's already been claimed 15 times over. One Singapore arbitrage desk reported, "We tried to execute, bought 200 COMEX contracts, contacted Shanghai buyers. They want metal in hand within 72 hours. We can't source it, trade aborted." The arbitrage mechanism, the fundamental connector between global silver markets, just failed completely. If you're holding paper positions expecting to convert to physical, the door to that conversion is slamming shut in real time. The historical context made the current crisis even more alarming. In 1980, the Hunt brothers drove silver to $50 before exchanges changed rules to break the rally. In 2011, silver hit $49.80 before margin hikes killed momentum. Those were engineered collapses, regulatory interventions designed to stop price runs. This situation completely different. No exchange had changed margin requirements. No regulator had intervened. The rules remained constant, yet the divergence kept expanding. By 10:25 a.m., Shanghai physical premiums reached $62 over COMEX, a 217% gap. One Hong Kong precious metals analyst noted, "In 80 and 11, they killed demand by making leverage expensive. Today, demand is killing supply, and there's no regulatory tool that creates physical metal out of thin air. The system isn't being manipulated, it's being exposed. Decades of fractional reserve precious metals trading, where the same ounce gets sold to 20 different buyers as paper contracts, are colliding with a sudden demand for actual delivery. The paper promises are meeting physical reality, and physical reality doesn't care about contract terms or exchange guarantees." Dealer inventories in Shanghai painted a picture of total depletion. Major Chinese bullion dealers, 1,000 ounce bars completely unavailable. 100 ounce bars back-ordered indefinitely, 1 kilogram bars showing pre-order only with no delivery timeline. Meanwhile, COMEX open interest remained at 180,000 contracts, 900 million ounces of paper claims. COMEX registered inventory available for delivery, 52,000 ounces. The ratio, 17,307 paper claims per deliverable ounce. One Shanghai vault operator reported, "We have clients offering $90 per ounce for immediate delivery. We have zero inventory to sell them. The metal doesn't exist at any price we can access." Screen prices showed COMEX at $28.80. Physical market showed Shanghai at $87. The 58-20 gap represented a 202% premium, not over some theoretical spot price, but over actual tradable COMEX futures. If you hold an ETF, a futures contract, or an unallocated account, you own a claim on metal trading at $28. If you try to convert that claim to actual metal, you're paying $87. The difference, $59 per ounce, is the cost of discovering your paper isn't worth what you thought it was. By 10:45 a.m., the arbitrage failure became the dominant story. Arbitrage between markets is supposed to be automatic. Price discrepancies get eliminated by traders buying low and selling high until equilibrium is restored. Here's what should be happening. Western traders buy COMEX futures at $29, take delivery of physical metal, ship it to Shanghai, sell at $88, net $59 profit minus shipping and insurance. Even with costs, that's a 55 PLARs per ounce gain. Risk-free, mechanical, obvious. Yet, COMEX Shanghai arbitrage flows had completely stopped. Why? Because step 2, take delivery of physical metal, was impossible. COMEX couldn't deliver against the volume of delivery requests already in the system. One London arbitrage fund described the problem. We can buy COMEX contracts all day. We cannot get physical delivery in any time frame that makes the trade viable. By the time metal might be available, if ever, the Shanghai premium could be gone or higher. We can't execute. The mechanism relied on COMEX's ability to convert paper to metal. That conversion process had broken. Paper and physical had officially decoupled. They were now two different assets, trading in two different markets, with a $60 gap between them that no one could close. The physical market reality showed up in lease rate explosions. Silver lease rates, the cost to borrow physical metal for short-term needs, spiked to 15% annualized by 11:20 a.m. Eastern. Normal lease rates, 0.5%. A 15% lease rate means physical silver is virtually unavailable to borrow at any reasonable cost. Industrial users who rely on leased silver to maintain production faced impossible economics. One electronics manufacturer in Shenzhen reported, "We lease 50,000 ounces monthly for component production. Our lease rate just went from 0.4% to 15%. That's a 3,650% increase in our metal financing costs. We either shut down production lines or pay prices that make our products uncompetitive." Short sellers faced even worse scenarios. They'd borrowed silver at 0.4%, sold it at $30, planning to buy back at $25. Now they faced 15% borrowing costs, a spot price of $29 on paper, and an $88 physical price if they tried to return actual metal to lenders. Some couldn't close positions because there was no metal available to buy back and return. Exchange notices went out. Failure to deliver physical settlement will result in cash settlement at prevailing physical market prices. Prevailing physical market price, $88. COMEX price, $29. The $59 gap meant shorts were being obliterated. While COMEX maintained an illusion of stability, Shanghai physical markets were in chaos. COMEX futures showed a tight $28.60, $29.40 trading range through the late morning, less than 3% intraday volatility. Paper market participants looking only at Western screens would see nothing particularly alarming. Toggled as Shanghai physical market, prices ranged from $85 to $92 per ounce depending on delivery timeline and bar size. Premiums over COMEX now spanning 56.63. That's a 195 to 220% premium range. One Beijing dealer updated their website at 11:45 a.m. local time. All products unavailable. Custom orders require 60% deposit, delivery unconfirmed, pricing subject to revision. Translation: we'll take your money, we can't promise metal, and we might charge you more later. The dual reality was complete. Western paper markets operated in a world where silver cost $29 and traded with normal liquidity. Eastern physical markets operated in a world where silver cost $90 and didn't exist in available form. Which price is real? Both, for different assets. Paper silver is abundant and cheap. Physical silver is scarce and expensive. If you own the paper version and want to convert to physical, you're about to discover the $61 conversion fee that nobody mentioned when you bought your ETF shares. The supply-demand mathematics made the crisis inevitable. Global silver mine production, approximately 830 million ounces annually. Industrial demand, 560 million ounces. Consumed in electronics, solar panels, batteries, medical equipment. Add investment demand, 210 million. Jewelry, 140 million. And silverware, 45 million. Total demand equals 955 million ounces. Production minus demand, negative 125 million ounces per year. That deficit gets filled by above-ground stockpiles and recycling. But here's the critical detail. Those above-ground stockpiles are already claimed by existing paper contracts. COMEX, LBMA, and other exchanges have issued contracts against the same physical ounces multiple times. Fractional reserve banking applied to precious metals. It worked fine when only 2 to 3% of paper holders ever requested delivery. Now imagine 10% trying to convert paper to metal. That's 90 million ounces of delivery requests against a system running a 125 million ounce annual deficit. The math doesn't work. One mining analyst explained, "You can't print silver. You can't create it with monetary policy. You either dig it out of the ground at 830 million ounces per year, or you don't. Demand exceeds that by 125 million. The only reason prices haven't exploded globally is because most silver is paper that will never convert to metal. Shanghai just called that bluff." By noon, Eastern forced delivery mechanisms were creating cascading failures. March COMEX contracts, expiring in 6 days, showed delivery requests at 8,200 contracts representing 41 million ounces. COMEX registered inventory available for delivery, 52,000 ounces. Even if every single ounce of registered inventory was delivered to March longs, that covers 0.12% of requests. The remaining 99.88% gets cash settled. Here's the trap. Cash settlement happens at COMEX prices, not physical market prices. COMEX shows 29. Physical market shows 89. If you hold a contract for 5,000 ounces expecting delivery, you receive a $145,000 cash settlement. Then you try to buy physical at $89 and need $445,000. You're $300,000 short. One institutional trader described it. "We're being settled at paper prices for metal that doesn't exist at those prices. It's like the exchange saying, 'Here's $100K for your house,' when houses actually cost $300K. You're not whole. You're massively short, and you still don't have a house." Multiply this across institutional positions. Hundreds of contracts, tens of millions in forced losses. And every cash settlement creates immediate physical buying pressure. Settled longs rush to buy actual metal. That buying hits a market already showing 60 plus premiums. Prices rise further. The gap widens. More contracts get cash settled. The doom loop accelerates. The gamma squeeze mechanics added algorithmic fuel to the crisis. Options market on silver showed massive open interest in call options at $35, $45, and $60 strikes. As spot pushed through these levels in physical markets, even while COMEX paper stayed below 30, market makers faced delta hedging requirements. They'd sold calls naked without holding underlying silver. Now those calls were in the money based on physical prices, forcing mechanical hedging. Here's the cascade. Rising physical prices force market makers to buy COMEX futures to hedge exposure, which pushes COMEX prices higher, which triggers more hedging requirements, which forces more buying. One options desk reported at 12:30 p.m., "We have 15,000 contracts of $45 calls in the money based on Shanghai physical. Each contract requires hedging with futures. That's 75 million ounces of forced buying pressure hitting a COMEX system with 52,000 ounces of deliverable inventory. The numbers are mathematically insane." Gamma mechanics don't care about fundamentals. They're purely systematic, algorithmic, forced. Short sellers who'd bet on lower prices now faced margin calls as COMEX prices started creeping higher. Brokers demanded additional collateral. Accounts got liquidated, forced buying into a rising market. One institutional short described it as being caught in a mechanical grinder. The system is forcing you to buy at higher and higher prices, and there's no escape route because the exit is blocked by everyone else trying to escape simultaneously. Backwardation deepened as the delivery crisis intensified. By 1:15 p.m. Eastern, COMEX silver futures showed severe inversion. March contracts at 31.20, June contracts at 29.80, September at 28.90. That's backwardation, near-term contracts trading above distant contracts. It signals immediate scarcity. The market is screaming, "We need metal now, not later." Normal contango, where distant contracts trade higher than near contracts due to storage and financing costs, had completely inverted. The backwardation spread between March and September hit $230 per ounce. One veteran COMEX trader noted, "I've seen backwardation during supply disruptions. I've never seen it persist this deep with physical premiums this extreme." The market is telling you, if you want metal now, you pay up. If you're willing to wait 6 months, maybe prices normalize, but probably not. Shanghai physical dealers reported 20% premiums for any bar with delivery within 2 weeks. 4-week delivery, 25% premiums. 8-week delivery, nobody's quoting because nobody knows if they can source metal that far out. The inversion proved the crisis wasn't about price speculation. It was about physical unavailability. Futures markets exist to transfer price risk across time, but they only work if the underlying commodity actually exists and can be delivered. When it doesn't, backwardation becomes permanent until either supply increases or demand collapses. Geopolitical dynamics entered the equation and closed the escape routes. At 1:45 p.m. Eastern, China's Ministry of Commerce issued a statement emphasizing strategic commodity security and national resource prioritization. Russia announced expanded export licensing requirements for precious metals, effectively restricting outbound flows. India raised import duties on silver from 10% to 18%. Suddenly, this wasn't just a market dynamic, it was nations securing strategic reserves. Western paper markets relied on global metal flows to maintain settlement credibility. Cut those flows, and the fractional reserve system collapses faster. One geopolitical analyst explained, when countries start restricting commodity exports, it signals they expect currency instability or resource scarcity. Silver is monetary metal, industrial input, and strategic reserve simultaneously. They're not letting it leave. COMEX registered inventory dropped another 12,000 ounces as international holders withdrew metal to sovereign vaults beyond exchange jurisdiction. Remaining registered inventory, 40,000 ounces. Open interest, 180,000 contracts. New ratio, 22,500 to 1. The global physical squeeze was tightening, and geopolitical controls were ensuring Western paper markets couldn't access Eastern physical supply to settle contracts. The arbitrage route wasn't just economically blocked, it was being jurisdictionally sealed. Shanghai physical at $91, COMEX paper at $31 gap, $60, and no mechanism left to close it. By 2:15 p.m. Eastern, the endgame mechanics were undeniable. Shanghai dealers reported zero availability of 1,000-ounce bars at any price below $95. COMEX futures, 32 or 10. Physical market in China, $95. The divergence hit $62.90, a 196% premium. Major Chinese bullion retailers updated their sites. All inventory sold, pre-orders require full payment in advance. Delivery timeline cannot be guaranteed, prices subject to daily revision. One Shenzhen vault operator stated plainly, "We have wealthy clients offering $100 per ounce for immediate delivery. We have nothing to sell. The metal isn't in China, it's not in London, it's not in New York. It's either underground still, already consumed in industrial applications, or held by people who won't sell at current prices." COMEX registered inventory 40,000 ounces. March contract delivery requests 8,200 contracts, March 41 million ounces. The system could deliver 0.097% of requested metal. The remaining 99.9% would be cash settled at $32, forcing buyers into a physical market trading at $95. Industrial users, manufacturers who need silver for production, not investment, started bypassing exchanges entirely. Direct deals with mines, off-market purchases from recyclers, premiums over spot didn't matter if you couldn't get metal at any spot price. The paper market was losing its function as a price discovery mechanism because it had lost its connection to the physical commodity it supposedly represented. The final data point removed all doubt about systemic failure. March 14th, 3 p.m. EST, market close. COMEX silver futures settled at $33.40. Shanghai physical market closed with silver trading at $98 per ounce for any bar available within 48 hours. The premium, $64.60 per ounce, a 193% gap. Over the final 2 hours of trading, the divergence hadn't narrowed, it had widened. Backwardation persisted, March at $33.40, September at $30.10. Lease rates closed at 14.8% annualized. Registered COMEX inventory, 40,000 ounces after further withdrawals. Open interest, 178,000 contracts. Ratio, 20 to 250 paper claims per deliverable ounce. One exchange official, speaking anonymously, admitted, "We're watching a fractional reserve system collapse in real time. The paper market made promises it can't keep. Physical holders know it. They're charging premiums that reflect actual scarcity, not paper prices that reflect contract abundance. Watch these numbers. Shanghai physical price, 98. COMEX paper price, 33. Registered inventory, 40,000 Aussie. Delivery requests, 41 million Oz. The gap between promised delivery and actual capability isn't closing, it's expanding. The system that was supposed to connect global silver markets through arbitrage never showed up. Because it can't. The metal doesn't exist in deliverable form at prices the paper market claims. This isn't volatility. It's the moment physical reality stopped accepting paper promises.